A staggering amount of physical metal has moved out of exchange vaults in just 48 hours, signaling a significant shift in the silver market. In this brief period, 3,446 contracts stood for delivery, equating to a total volume of 17.23 million ounces of physical silver. This movement represents roughly 2% of the entire world's annual mining production shifted in just 2 trading sessions. The intent behind this surge is not driven by industrial demand. Rather, it appears to be a coordinated raid on inventory by major banks such as JP Morgan and Citigroup. These institutions are targeting the remaining 39 million ounces of registered silver, which is available for sale, indicating a strategic play to control the market. While the big banks are engaged in a fierce battle over wholesale bars, the retail market for individual investors has effectively collapsed. Major dealers like SD Bullion, Kitco, and APMEX are reporting mass out-of-stock notices, leading to an inventory blackout. The premium for retail coins has exploded, with the paper spot price sitting at $71, while retail coins are being sold for between $89 to $95. This disparity creates an $18 to $24 premium per ounce, signaling a total bifurcation between the digital price and the physical reality. Furthermore, some dealers are quoting March for the next shipment of American Silver Eagles, as the U.S. Mint struggles to find silver blanks, creating an alarming situation for retail investors. The report highlights that the world's physical silver foundations are crumbling in real time. Data shows a daily hemorrhage of remaining inventory across major exchanges. For instance, the COMEX in New York has approximately 2.8 million ounces left, which, at the current rate, will be depleted in about 2.5 days. Meanwhile, the Shanghai Futures Exchange holds around 1.5 million ounces, which translates to about 14 days of supply. A significant factor in this scenario is the China wall, as China has banned exports, causing domestic manufacturers in sectors like solar and electronics to panic buy their own exchange inventory, ensuring no silver leaves the country to assist Western markets. A darker psychological aspect of this report emerges with the shift in banking behavior. The traditional potato shuffle, where banks trade paper silver back and forth to keep prices low, seems to be ending. Instead, banks are now taking physical delivery to bury the metal in their own private fortresses. Deutsche Bank appears to be the victim in this scenario, forced to vomit up millions of ounces to rivals like JP Morgan. The strategy here is clear. Banks are not going bankrupt, as they possess trillions in capital. They are realizing that while paper money is infinite, silver is finite. By swapping digital dollars for every physical ounce they can grab, they are front-running a massive revaluation in the market. The speaker concludes that the Silvergeddon scenario is no longer a mere theory. It is now a live situation. Possession has become everything, as the spot price has turned into a tool of deception. Although it may indicate $71, if investors cannot purchase silver at that price, the figure becomes irrelevant. Waiting for a lower price on the chart may lead to a total lack of available metal, as inventory is sequestered by the blue whales or big banks. The bottom line is that we are currently experiencing a physical lockout. The banks have shifted from a short position to a long one, effectively destroying their competition and the retail public to secure the last lifeboats of physical metal.